Hola y bienvenidos a 30 Minutos Huevos. Me llamo Amit. Estamos directivo en Facebook. Whew, I got it. Oh my goodness. Welcome, greetings, hello, and welcome to another 30-Minute Thursday. My name is Amit. We are live on Facebook, and I am still working on my Spanish. Every day it gets a little bit better, but I am kind of like a 3-year-old or a 4-year-old. I discover all these new words that like pop into my mind. And I'm like, oh my gosh, I got to use that in a sentence. So I kind of remember the foreign language that I'm working on. And I'll tell you why I'm working on a foreign language at another time, but it's never a bad idea to be able to speak in a different language. It's also a good thing to get your mind sharp. And heaven knows I need to get my mind sharp. So I hope you guys are doing well. I hope you guys are staying safe, staying healthy, staying sane. Really, really super important that we stay sane in this very, very odd world that we find ourselves in. And thank you for joining me on this really chilly, wintry day here in the Pacific Northwest. I've got my warm sweater, which might be a little too warm because we're in the beautiful studios of New American Funding, and all these lights and all these other effects that are in use to make me look somewhat normal and reasonable. They're kind of hot. They throw off a fair amount of heat. And so I imagine that I might start to look like a wax figure starting to melt down the road here. But for now, it is winter in the Northwest. We went from 85 degrees just a couple of weeks ago to now 45 degrees and rainy. And it's perfect weather for Halloween. It's perfect weather for Thanksgiving coming up. The leaves are changing. It's a really nice time of year. It's actually my favorite time of year in Spanish, in Espanol, Antonio, autumn. But it was a bit of a surprise and a bit of a kick in the teeth. And so we're getting used to that. Other surprises that kicked us in the teeth, the Federal Reserve Board. We got to love these guys. These people are, heaven help us. They're doing the best they can. I try to be nice. My mom used to say, if you have nothing nice to say nothing at all. Well, if I do that, it's going to be a really short 30 minutes. I tell you that right now, because what can I tell you? There was the Federal Reserve met yesterday, and as expected, they are increasing, or they did increase the short term interest rates by another 0.75%. So now the Fed has taken their overnight rate from really zero. I mean, it was a little bit. They can't charge zero. So it was like in March of 2022, it was between 0% and 0.25%. So we would call that a quarter of 1%, somewhere in that range. And they've taken it now to 4, and Espanol cuatro. So the Fed funds rate now is 4%. And they've told us that in their December 14th meeting, that they're planning to take it up another 50 basis points, 4.50, 4.5 or 4.50. That's yet to be determined. And I'm going to stop with the Spanish now, guys, because you might find it charming and you might find it annoying, but it's going to throw off my mind. I'm already thinking in other language. So, yeah, so the Fed came in and raised interest rates. Now, this was not a surprise. This we knew. But what was interesting is that after their meeting, the Fed, and specifically Jerome Powell, who is chairman of the Federal Reserve Board, and specifically the Federal Open Market Committee. This is the group that actually votes. There's a lot of Fed members, there's regional governors, there's presidents of regions and things like that. And I'm not going to go into the detail of how they've organized this agency, but the members that vote are on the FOMC, the Federal Open Market Committee, of which Jerome Powell is the chairman. And so he's the boss. He's got to make statements after they make their announcement. So he was addressing the media yesterday afternoon. And it's interesting. Somebody asked him a question from the audience, a member of the media. And if you watch the stock market, which I do when I can, and you watch the bond market, which I do as much as I possibly can, it's really interesting to see these things in real time, because the markets actually responded somewhat favorably when the Federal Reserve Board made their initial announcement, because we knew, I mean, it was baked into the cake. Everybody knew that they were going to raise the rates by 0.75%. So the markets took that and they said, well, hey, everything's going according to plan. Everything's going as we were told. So we're just humming along doing whatever. Then in live time, in real time, en vivo. Sorry, I said no more Spanish. Sorry. Please, I'm like a dog with a bone. I'm like a kid with a new toy. I can't help it. But in real time, in live streaming, somebody from the media asked Jerome Powell and said something to the effect, hey, the markets seem to be enjoying a bit of a rally, seem to be doing okay, and seem to be doing well with this announcement. What do you have to say about that? And Jerome Powell basically spent the next 2 minutes or longer telling the world why they're not done raising rates, why they want to see significantly more. I'm paraphrasing here, but basically, they want to see significantly more damage to the markets, to the housing market, to the equity markets, to basically all markets to bring things down. They want to see, they're not finished raising rates. And Jerome Powell said specifically, we would rather run the risk of overdoing it and raising rates too high and causing a lot of damage to the market in the short term, and then unwinding that, reducing rates down the road and kind of easing the monetary flow after the fact. But we would rather raise rates more than we should right now and overcorrect rather than undercorrect. And when he said that, the markets sold off severely. And we're watching it in real time. It's absolutely uncanny to see what's going on here. But the markets, being the stock market, the S&P 500, the Dow, the NASDAQ, the Russell 2000, basically where your retirement funds are, where my retirement funds are, all of those markets had a terrible day, as did the bond market. They all sold off because the investors are not comfortable with what's going on with inflation and with the way the Federal Reserve Board is treating this situation. And so when Jerome Powell said that, they reacted. And it's, gosh, I don't know what to say about that. Like I said, my mom said, if you don't have anything nice to say, try not to say anything at all. The Fed's job is to rein in inflation. The Fed's primary mission at this day and age is to keep inflation year over year at 2%. And they have failed miserably at that. We are well into the 8% range. And I would say, honestly, if we tabulated inflation the way they did in the late 1970s and the early 1980s, we're probably well into double digit inflation, probably 15%, maybe even more. The Fed failed miserably. They didn't see it coming initially, right? During the COVID lockdowns and coming out of COVID in 2021, they didn't see inflation as a problem. Then they said it was going to be transitory inflation and it wasn't going to be a long lasting problem. And as supply chains got fixed up, then it would be corrected. Then they said, well, it's not going to be transitory, but it's not going to be severe. Now they're saying, well, look, it's so severe that we're going to have to do other things, basically trash the economy in order to get this under control. That's basically what they're saying. I don't know if you guys, this is a little bit of a non sequitur, but not exactly. Jerome Powell is going to go down at this point in time as probably one of the villains of Federal Reserve Board history. He's going to go down as a failure at having done a really poor job of managing this economy and managing our monetary policy as far as trying to prevent inflation from doing what it's doing. He is right now trying to salvage his reputation and trying to salvage his legacy. That's my interpretation. Now, I might be totally wrong, but I want to believe that this guy wants to go out as a hero and not a villain. And right now, he's not doing too well with that. And I'm reminded of a movie. Some of you older folks may have seen this movie. It's very hard to see on TV these days because it's wildly politically incorrect. The name of the movie is Blazing Saddles by Mel Brooks. And in that movie, Mel Brooks plays the governor of a state in the 1870s or some period of time after the Civil War. And the governor finds out that there's a problem in one of the cities that he's governor over. And he says, gentlemen, we must do something to save our phony baloney jobs. And they all, his cabinet members and whatnot, start screaming, harumph, harumph, harumph. And they all start pounding the table and doing things to try to make it look like they're doing something. Jerome Powell is trying to save his phony baloney reputation. And they're all pounding the table right now, and they're all pounding the desk to say, hey, we've got to do something. And we would rather do more and overcorrect than undercorrect and see how things happen. And so they're going full steam ahead. And the danger of this, as I've said time and again, is twofold. Number one, our economy does not move quickly. It's not like a speedboat or a jet ski. It's not super maneuverable. I equate it to one of those gigantic cruise liners. I saw a really interesting picture. I don't know if it's true or not on Facebook. You know, anything can be photoshopped, including my appearance right now. But I saw this photo of the Titanic, and behind it was like one of the modern cruise ships that are like 80 times larger than what was at the time the biggest cruise liner to hit the waters. Whatever it is, our economy is like these cruise liners. It's massive and it doesn't move quickly. It doesn't turn fast. And so what the Fed is doing right now is just turning and turning and turning the wheel without waiting to see what happens with the direction that we're going and with the, in sailing terms, the heel of the boat, the tilt, basically. So they're just going to crank it and the thing may just tip over. And the Fed is going to be, quote unquote, okay with that because they've got to do something to save their phony baloney jobs. Harumph. Um, at the same time, there are people who say that the Fed is driving while looking in the rearview mirror, meaning that we're heading straight on into whatever's going on in our economy, down the street, up the street, whatever it is. But they're looking in the rearview mirror at all of these statistics and all of these compilation of the consumer price index reports and other employment numbers and things like that from the past. So they're looking in the rearview mirror while driving forward. Most of us know that that's pretty much a recipe for disaster when you're trying to navigate a vehicle. And yet this is what the Fed is doing. So let me answer the question, why is the Fed doing this? Well, bottom line is that inflation's gotten out of control. The Fed's number one job is to contain inflation. They've failed miserably to do that for whatever reason. And we could talk about the pandemic and we could talk about relief that government tried to float into our economy and things of that nature. But, you know, this is kind of a politicized situation. The Fed's supposed to be apolitical, non-political, but they have politicians that call on them. And I've been reading about certain members of Congress, certain members of the executive saying to the Fed it publicly, like, hey, y'all have to cool this for a little while before we get into the elections, which are coming up in less than a week now. Y'all have to make this a little bit more manageable. Y'all have to mitigate this. There's always politics, guys. I mean, we would be foolish or naive to think that politics doesn't impact what goes on at the Federal Reserve Board, right? I mean, they've got political patrons. These are jobs in some cases that are appointed and then confirmed by the Senate. So there's definitely politics at play. And what the Fed does is what we refer to as monetary policy. What the executive branch and the Congress do is what we refer to as fiscal policy. So basically, the president and the Congress and the president's executive department, they set fiscal policy. They decide how much money we're going to spend and what we're going to spend it on. The Fed's job is to decide and to figure out how to pay for it. And those two houses have got to speak with one another. There has to be some kind of conversation that says, in a perfect world or in a real world or in just honest conversation, hey, the monetary policy required to pay the bills for your fiscal policy is going to go out of control. It's going to create problems. That never happened so far as I know. Now, look, I wasn't consulted. I wasn't involved. I would have loved to have been a fly on the wall in any of these conversations and meetings, but I have my job, they have their job. I'm just looking at what's happening in our economy and how things are evolving. And I'm just seeing that it seems that one hand doesn't know what the other hand is doing. And so we're kind of stuck with this policy. And now the Fed's working to overcorrect. When will they be finished is the question. And my answer is when they see higher unemployment. The unemployment rate is currently 3.6%. I would imagine that somewhere around 5%, maybe 6% unemployment, the Fed is going to say, we've achieved our goals. And why is that the case? Why do they want to see people lose their jobs? Because they're cruel and they're mean people? Not necessarily. I can't say yes, I can't say no. What I can say is that what the Fed is doing by raising these short-term interest rates, I've spoken about it before, I'll continue to explain it. What they're trying to do is pull money out of the economy. Now, this is a polite way of saying they want to cause unemployment, because when unemployment happens, people stop spending freely. Whatever you are spending your money on when you've got money coming in, that changes immediately and dramatically the moment you get a pink slip. The moment you get, a severance package, you're going on unemployment insurance, whatever it is, all of a sudden everything stops, and the only thing you're spending your money on, unfortunately, are the bare necessities until you get back on your feet. This is what happens. And so when the Fed talks about fixing the economy, what they're talking about in polite terms is we want to destroy demand. That's their words, not mine. They want to eliminate a consumer's demand to buy products, to onboard services, to hire people, to do things. Because when we stop spending money on things, what happens is the supply is here, but the demand is. I touched the microphone. Sorry for the people who I might have done damage. Forgot about that thing. The supply is here, the demand is here, and price is somewhere in between. Well, price is going to have to come down in order for the demand to come back up to meet the supply. So the Fed is talking about killing demand, and that, by a definition, is going to bring prices down and will help bring demand eventually back up by way of killing inflation. But what they really mean, between the lines, if you read between the lines, what they're really talking about is they want to see unemployment higher. And when we have higher rates of unemployment, demand dries up all by itself. That is not polite to say. That is not politically feasible. That is not something that they are going to be, shouting from the rooftops and letting everybody know, hey, we want to see you guys lose your jobs. But that's what's coming. That's really what they're trying to do. And in the course of doing that, this inflation problem will take care of itself. So the Fed is working on its phony baloney legacy, its phony baloney job, harumph, harumph, harumph. If you've not seen the movie Blazing Saddles, I highly recommend watching it. I'm going to tell you right now, it is wildly offensive, but it is funny. It is Mel Brooks funny, and we need a good laugh these days. And that's really what the Fed is doing. So let me check my time here. All right, we've got about 10 minutes. So the Fed has decided, as I said, that they're going to overcorrect. They're going to keep the pedal to the metal on this thing until they see real responsiveness from the economy. And the cruel joke of this is that they started raising rates in March, and they went from zero. Basically, they raised rates by 25 basis points, quarter of 1% in March. And then in April by, another 50 basis points. They weren't even at 1% in April of this year. It takes, honestly, 6 to 8 months before the economy starts to feel the effects of any of these rate increases. Think about it. What they're increasing the rates on are your credit card interest rates. They don't have control over the credit card interest rates. That's set by Visa, that's set by Amex, whoever it is. But when the Fed raises the rates that they charge to member banks, the member banks, and that's Visa and Citibank and Amex and Bank of America and everyone that you get your credit through, they pass those rates on to you. They don't just sit there and say, oh gosh, we're going to lose another 0.75% in profit margin. They pass that cost to you and to me and to everybody who carries a balance on their credit card, as an example. So it takes some time, though. So the Fed raises their interest rates by, let's just say, 0.75% yesterday. That interest rate hike, you're not going to feel that on your next statement. You're going to feel that on the statement after the next statement. You're going to start to see that. So you're talking about roughly 2 months or 6 weeks or somewhere in between there before the consumer really starts to feel the higher interest rates and the cost of carrying a balance on those credit cards. So the Fed keeps pouring, gasoline. Hey, can we get the fire hotter? Can we get the fire hotter? Can we get the fire hotter? But they haven't really given it time for all the tinder to catch. So they don't even know how hot the fire is going to be. They just keep pouring gasoline on the fire. And again, they started in March. We are now in the early part of November. So it has been roughly 8 full months since they started this process. It is just now the stuff that they did in March and in April, just now starting to, to take hold in the economy. But they're going to continue to raise those rates, and they're going to continue to do that, like I said, because they want to see employment come down, unemployment go up. They want to see people not spending money on goods and services. And by definition, those goods and services will come down in cost, will come down in price. And as that happens, proof the rate of inflation will go down. If you define inflation as a rise of costs for goods and services, so if costs for goods and services come down, then by definition, the rate of inflation has come down and the Fed has saved their phony baloney jobs. I say phony baloney. I'm sure they've got a real job, and I'm sure it's a significant job. I'm just being playful because I got Blazing Saddles on my mind. The rate of inflation is really more about how much money is in circulation. Inflation is not the rise of costs of goods and services by textbook definition. Inflation is the expansion of the amount of money that is in our economy. And that is, I mean, we've expanded it. We dumped a lot of money into our economy over the last 2, 3 years because of COVID, and then because of the Inflation Reduction Act and a lot of these other expenses that the government has taken on. And so there may be inflation with us for some time to come. And that is frustrating. It's scary. We don't know exactly when it's going to stop. We don't know exactly what it's going to look like. We have roadmaps from the past that may suggest what things may look like in the present and in the future. But really, we're just going to have to ride this thing out. And the Federal Reserve Board chairman has told us in no uncertain terms that, yes, they plan on continuing this approach, and they'd rather overcorrect and fix it later than undercorrect and let the economy continue to suffer under the burden of this very heavy inflationary pressure. So here we are. Now, what does that mean to real estate and mortgages? Right now, it's a very rocky period of time. I'm not going to sugarcoat it. We're all working through significantly reduced demand. In the mortgage space, refinances are down 85% from last year to this year. In the purchase space, we're down about 41% on applications for new home purchases from this time last year to this time this year. That's a significant reduction in activity. And no one's going to tell you otherwise. I mean, anyone who does is going to kind of be fooling with you or hoping that you're not listening to these podcasts and these live broadcasts and knowing what's actually going on here. But here's the thing. Because all of this stuff is happening, sellers who want to sell really want to sell. They really need to sell. And buyers who are in a position to buy, now is your time to really start making offers, to really start negotiating with sellers, to have the sellers pay for your 3-2-1 buy down. 3, 2, 1, got to get the right fingers, the 3-2-1 buy down, to get the sellers to pay for your closing costs, to get the sellers to reduce their purchase price, to get the sellers to consider taking a contingent offer, contingent on you selling your current home or working with me on the buyer accepted program, which we could talk about another time, and becoming a cash buyer, not contingent on selling your current home. Right now is the absolute best time we've seen over the last 2 years to be a buyer, because things are so rocky in the space, because we need buyers, and sellers who want to sell or need to sell really have to make a deal. So they're not going to cut, their prices in half. They're not going to put the homes on the market like we saw in 2008 and 2009. They don't have to take a severe loss, but I'm seeing a lot of people making a lot of deals right now. It's like that old TV show, the game show, Let's Make a Deal with Monty Hall. Right now, we can play Let's Make a Deal. So if you are in the market to buy a home, if you are thinking that this might be an opportunity for you, I'm here to tell you, yes, it is absolutely an opportunity for you. Please call me. You can find me through Facebook. Please call your real estate partner. They can find me through Facebook. If you can't find me there, Google me, Amit Baruch. There's not too many of us out there. I'm sure I'm going to hop up to the top of your search. Find me, call me. Let's talk about what we can actually do, because while this might be a scary time, it will pass. And when it does pass, we're going to see rates come way down. And when interest rates come way down, guess what? We're refinancing everybody. In fact, as I mentioned before, New American Funding has got a program in place. If you buy your home with us right now, we close your loan within this calendar year. Anytime in the next 5 years, if you want to refinance, we're not going to charge you our lender fee, and we're also going to credit you $500 toward the appraisal. So that turns out to about $2,000 in savings. And we will put that in writing, and I would be happy to do that purchase loan for you and that eventual refi. So my point in all this, as we're getting, we are right close to time. My point in all this is we can look at the negative and we can complain about Jerome Powell and we can complain about the Fed. And believe me, they deserve to hear some of our complaints. But at the same time, it's not going to change anything. As I've told a friend in the past, for us to argue about this, for us to argue about politics or argue about monetary policy or fiscal policy is like two fleas arguing about what breed of dog they're on. It has absolutely no bearing. The dog's going to go where the dog's going to go, regardless of whether it's a Chihuahua or a St. Bernard. So rather than worry about that, let's talk about what we can do, because we are in a unique time that we have not seen in the last 2, maybe 3 years. So if you want to be a buyer, now's the time to be a buyer. I urge you to not read all the negative stuff and to look at all the things that we could do and all the things that you can possibly get into now when you couldn't a year ago. Like, absolutely, it was never going to happen. So it's not all doom and gloom. The sun will come up. It will always be okay. We've got to work through some stuff. Hopefully the Fed will do something to save their harumph, and y'all should try the harumph on your own. It's cathartic. Until then, we're at our time. So I promise I'll continue to bring you more information. I will do the best I can to speak better Spanish along the way. Certainly, I want to keep it upbeat and optimistic while still telling you the truth, because I don't know if a lot of our media is really savvy enough to know what's going on. I mean, it's hard to relay this much information in a 1 minute or 2 minute news clip. So I will continue doing that. And until then, I look forward to continue to seeing you on Thursday afternoon, right here, live on Facebook, 2 p.m. Pacific time. Until next time, please stay safe, stay healthy, stay sane. Really important to stay sane and stay warm. It's getting cold out there. Enjoy your next week, your next weekend. And until next time, thank you so much for spending a little bit of time with me today. Have a great one. Be well.